What happened? There we go. So within this class, how to read your credit report, today we'll be talking about some of the in and outs of reading the report. Now, keep in mind, this is not technically information on how to build credit or we have classes on that. This is specifically pertaining to how to read the report. So to give you a little bit of background, in some of our other classes, we tell you how to find your credit report, how to obtain a copy. This class is after you get that copy, how do you read this crazy document? So that's what we're talking about today. And I'm going to show you all some of the tricks that lenders use to figure out things about people that we might not necessarily know that matters. And my goal today is to encourage you enough to look at your credit report and hopefully give you a little bit of insight that you can start to understand some of the things that's on there. So before jumping into that, I will give you all a little bit of housekeeping, a little bit of background on Prosperity Connection. So Prosperity Connection, we're a nonprofit organization that offers free financial education within St. Louis and its surrounding regions. So we do this through one of two ways. We have group classes we teach as such. So before, as we were just previously talking about, our classes were in person. We have a couple different Excel centers out in the community, different communities in St. Louis. And unfortunately, just with everything going on, we're virtual right now. Hopefully sometime this year, we can get back to in person and things can have some normality to them. But till then, we will be virtual. And our classes are they're easy to be taken advantage of now because with us being virtual. Because before, if you signed up for a class, the class was free, but the cost was you driving to that class or you finding transportation to that class. Now our classes are virtual. All you got to do is sign up and click a link and you're in the class. So just like you all did today, congratulations to all of you. So that's the first way we help people through our financial classes. These classes can range from credit, budgeting, home buying, auto buying, reading credit reports as we're doing today, tons of different financial topics. And with those classes, we're just really scratching the surface of finances. These classes are meant to get you intrigued enough to start turning your wheels enough to say, hey, I think I may need some help with this. And then that's where the rubber meets the road with one-on-one financial coaching. See, with one-on-one financial coaching, that's where we meet with you one-on-one and help you achieve your financial goals. Now, the key to what I'm saying is we help you achieve your goals. What I am not going to do is achieve your goal for you. So with that being said, you got to come prepared to put a little bit of skin in the game. And we set it up this way because we learned you set someone up for more success when you teach them how to fish versus giving them a fish. So instead of saying, hey, pay me $100 and I'll make all your financial problems go away. There's plenty of people doing that. It doesn't help people. It literally keeps them where they are. What's going to stop you from making those same mistakes from putting you where you are? But when we say, hey, we'll step in, we'll help you come up with a game plan. We'll help you find ways to execute this game plan. We'll walk you through those steps. We'll hold your hand. We'll be a cheerleader. We'll laugh with you. We'll cry with you. We'll make it happen together. See, when you get out of that situation, you're less likely to put yourself back into it because you remember how hard you had to work to get out of that. And now that you have the keys and the wisdom to make it happen, you can now give that to friends. You can give that to family. You can give that to your children. You can make a way for other people to have a path towards financial independence. That is why we exist. So although I love teaching classes, one of my favorite aspects of my job, I will be lying if I said the magic did not happen within one-on-one financial coaching. So that's Prosperity Connection in a nutshell. Just give you all a little housekeeping for this class. I know it's virtual. If you all could please keep your cameras turned off. This class is being recorded. Mic's muted. If you want to ask a question, you're more than welcome to put it in the chat and we'll get to that question as we go through the presentation. Sometimes we even stop and take a few questions in between slides. So, all right, now I got all this stuff out the way. I know y'all like, I'm ready to hear some real stuff now. I came for a class. So here we go. We're going to get the presentation rolling. So how to read your credit report. Now, there are tons of different types of credit reports. You have different credit bureaus, and even within those credit bureaus, they have different reports. So you have to keep in mind that what we talk about today, these credit reports may look different, but the same information will be on there. Some are easier to read than others. Some are a little not as user friendly, and we'll kind of get into those nitty gritty topics. So just keep in mind the examples I show you all today, this won't be every single credit report. So first and foremost, getting your credit report. How do you get a copy of your credit report in the first place? You go to annualcreditreport.com. Do not go to freecreditscore.com. Don't go to freecreditreport.com. Matter of fact, if free is in the name, I encourage you to stay away from it. Hardly anything that has something in the name follows what it says. Just like the only dollar store that things cost $1 is Dollar Tree. Everything else ain't nothing in there $1. So, so if it has free in the name, don't even look at it. Just annualcreditreport.com. Here you can pull one report from each credit bureau once a year for free. So what this means is if you were to pull TransUnion, Equifax, and Experian today, you can pull all three of those again, May 20, I'm sorry, 5th? Yep, okay, I wrote that earlier. I was like, I got the date right. May 25th, 2022. So what I encourage people to do is when you are trying to start your credit journey, you're trying to build your credit, pull all three of them at one time. See what's out there, see what's going on, because you want to be sure that you're hitting all the stops when we building your credit report. Once you kind of get to a place of you kind of cruising your autopilot, you got this credit thing figured out, I'm coasting at the score that I want to stay at, or I'm at a pretty good score and I want to stay there, pull one report every 3 months. See, this gives you a report at the different time of the year. So that's just a little tidbit for how to get your report. So we go to annual credit report, we grab our report. Now we have our report in hand. Next is reading this thing. So one of the first things you're gonna see on your credit report is your identifying information. So this will be your personal identifying information. So social security number, birthday, names, alias. This section is big for, I tell a lot of people to go through this with a fine-tooth comb, because if you've ever been a victim of identity theft, I'm gonna do a little plug here. We have a class on identity theft. Check that out as well. I believe we also have it on YouTube. But if you've been a victim of identity theft, you are more than likely to see some evidence of that in your identifying information, whether that may be an address or phone number you've never heard of. Those are huge red flags for identity theft. So I always tell people, go through your identifying information with a fine-tooth comb and look through and see if you see anything that is wrong. If your name is wrong, that's something we got to dispute. We got to figure out, okay, well, why is my name wrong on here? Now, given if your name is Aaron and they spelled it with an E instead of an A, well, obviously someone made a mistake. But if it's a completely different name, that's a red flag. Keep in mind, both circumstances, we want it fixed. You don't want any wrong information on your credit report, but some wrong information is alarming, some isn't, some is just a mistake. So you got to keep that in mind. But that's your identifying information. So if you do have wrong information, we'll do disputes for those. A dispute is you telling the credit bureaus, hey, I believe this information is inaccurate. Can you all investigate and determine if it is inaccurate? They'll do their investigation. If it's inaccurate, they'll remove it from your credit report and update the information. Sometimes with identifying information, they'll ask you to verify. So if you're saying your social is wrong, you might have to provide documentation proving that that is not your social, or your birthday. They may have you send in a copy of your ID to the credit bureaus. Keep that in mind. So after identifying information, next we'll see addresses. So these addresses, these don't show necessarily every address we lived at, but it show addresses based off when we apply for things. This section of the credit report is very important because one key factor of obtaining funding in any sense is consistency. They want to see that you are consistent, because people who are consistent typically don't change, which means if I give you a loan, you will be consistent with your payments. So if you've been living somewhere 2 years or longer, it looks really good to lenders. If your living situation is staggered, so you're 6 months here, a year here, that tells them, okay, this person is a little flip-floppy. We don't know if we want to extend credit to them because they're not very consistent, or if your employment is not consistent. So once again, it's another part where you want to look through a fine-tooth comb. If you see an address that is not yours or that you do not recognize, I have seen some instances where people had addresses on their credit reports that weren't theirs. What happened is, if you co-sign for something, I've seen where lenders will put that information in. They'll put the same address for both people applying, even if they don't live together. So if you co-sign for something, so I have somebody like, oh, well, this isn't my address, but this is my brother's address. I co-signed for a car for him. Well, that's why there's owner. Once again, still a mistake. We don't want it there, but keep in mind, it may not be a red flag. It just may be something that's a mistake. So next is phone numbers. Phone numbers doesn't always show on the credit report, but depending on the one you have, it can have phone numbers on there. This information is submitted when you apply for something. So for instance, if you go apply for a car and they ask for your phone number, that's how that information gets reported to your credit report. When they pull your credit report, they enter that information in. So like I said, not all reports have them. I know for a fact Experian with annual credit report does. I cannot remember if Equifax and TransUnion does, but I know for a fact Experian does have phone numbers on there when you pull the report from annual credit report. All right, so next is employment history. We talked about this a little bit, kind of in the same aspect of address and your living circumstances, but same thing. They want to see you working somewhere, or at least in the same field, for 2 years or longer. So this information also shows up on your credit report. It shows the date that address was reported to your credit. So this lets them know the span of which the time you could have been living there. And also kind of fact checks what you said, because if you give them an address and you say you have been there for 2 years, then they pull your credit report and just this year you applied for something and it's a different address. Well, now that tells you, well, hold on, they're using 2 different addresses, but they said they've been at this address for a year. What's really going on? And that may cause them to probe and ask a few questions. So it helps in 2 different aspects. But the biggest thing about employment history is, once again, you want to be consistent. I get it. Sometimes we got to switch up jobs to get more pay, to get better circumstances. We may not like where we at. But a worst case scenario, if you plan on doing anything as far as lending or applying for something, try to keep it within the same field. That gives you a little bit of leeway with lenders. Because if you're a teacher at ABC High School and you've been there for 10 years, and then you just left ABC and you went to DEF High School, and now you've only been there for 6 months, but you're still a teacher, when they ask that information, you're gonna say, well, I've only been at DEF for 6 months, but I was at ABC for 10 years. I go, okay, well, got a different job, still a teacher. Okay, that'll make it look a little better to them. All right, so we just talked about the identifying information. This is what that identifying information looks like. So this is a credit report that we were able to use, and we had to alter a lot of the information. So I threw in all the different things here. It's kind of jokey, but still I wanted to make it somewhat real. So this is how it looks on a credit report. It'll show names, any alias of that name, shows the address and former address. And as we see, they also show the dates that those addresses were reported. So we see the dates there, we see the addresses here. Everything checks out. Shows jobs. Remember, they only do jobs based off when you apply for things. So they have a shift leader at Burger King, and then the former job was at Papa John's. Okay, so we see that they're consistent with where they worked. They work in restaurant and fast food. They left one place and went to another. Okay, so that makes sense. That still kind of checks out in the eyes of a lender, and that keeps them in good standing. All right, let me, do we have any questions in the chat or anything before I keep rolling? Okay, no, we good. Y'all, if y'all have any questions, please feel free to use the chat as we continue through this. Oh, also, I want to point this out. This is the credit nerd in me, but up here we see the in-file date. I didn't talk a lot about in-file date. So this date is kind of funny because the in-file date shows when your credit file was opened. So a credit file is typically open whenever you do anything involving credit. So whether that be applying for a car, when you apply for a car, if you've never done anything involving credit, that inquiry opens your credit file. And your in-file date will be whatever date you apply for that car. Or if something is put in your name, or if you become an authorized user. As someone on the lending side, this made it easy to be able to tell if someone had fake credit. So let me talk about what fake credit is. Let's say we have a 18-year-old guy and doesn't have any credit, but his mom goes and makes him an authorized user on her credit card. When she does that, that opens his credit file because he now has credit. And this will help his score go up because all his mom history he will get. Here's the downfall to that. Because he gets all her history from that card, he also gets his in-file date is the beginning date where that card was initially issued to her or that account was opened. So I once had a young guy, like literally 18, 19, and he was applying for a car, but his in-file date was like in the 80s. And I was like, now wait a minute. This is a huge red flag. There's no way you can have credit before you was even in existence. So funny how lenders use that. They can tell immediately when somebody has fake credit based off the in-file date. Like I said, not super necessary or pertaining to consumers. That's just a credit nerd in me. Whoops, hold up. All right, next is the credit score. So your credit score is like your financial GPA. So this number tells how likely are you to repay a loan. This score goes from 300 to 850. The target score we like to see is 720, meaning this is a good place to be. A lot of people believe that, oh, if I don't have a 700, I can't do anything. That's not true. You can do the same thing with a lower credit score. Here's the difference. You will pay substantially less for it at a 720 than you would at lower scores. So keep that in mind. You can still make it happen. You just don't pay a little more for it if you want to do it now. So if you need a car, like, look, well, I definitely got to find a way to get some transportation, which like, oh, I don't have a 700 credit score. You may still get approved for a vehicle. You might pay more for that vehicle. So I will come up with a plan to pay it off sooner so you don't pay a whole ton of money in interest. But keep in mind, you can still make it happen. On some credit reports, your credit score also shows on it. So when you pull your credit report with annualcreditreport.com, it does not have the credit score on there. Good thing is, as consumers, we want to focus more on the report anyway, because the information from the report is what generates the credit score. So good thing that we want to focus on the report, but I know a lot of people like, I really want to know my score. I want to know what my score is. So keep in mind, not all credit reports have the score on there. If you get your credit pulled by a lender and that lender gives you a copy of your credit report, those reports will definitely have the credit score on there. And that will look something like this. So these credit scores, this particular lender had two types of credit scores. So the first of which, they had a FICO score 08. I'm going to give you all a little background on this. So two types of scores you would see, a FICO score and a Vantage score. Vantage score is like Credit Karma, Credit Wise, Credit Sesame. Any type of educational credit platform, like the ones I named, most of the time, those will be a Vantage score. FICO score is what lenders use and what the credit bureaus use. So FICO score is what you want to look at. So if you all ever have an instance where You go on Credit Karma, you're like, oh, Credit Karma says my score is 675. Yeah, I'm gonna go apply for my car. Then you'll go apply for a car and you're like, oh, I'm sorry, you have a 600. You're like, what? I constantly hear people, Credit Karma lied to me. Credit Karma did not lie. They're using a different scoring system. So the two systems are Vantage and FICO. Think about them like cell phones, like iPhone and Android. At the end of the day, no matter which team you're on, whether you're team iPhone or team Android, we're not even gonna go into that argument. At the end of the day, they are cell phones. Both of them can call people, they can text people, they can take pictures, you can watch videos, all that they can do the exact same thing. There are slight differences based off each system. That is what FICO and Vantage is. Both of them are credit reports. They both have scores, they both have factors. They have different identifying factors. So to give you an example, one portion of the Vantage score is amounts owed. How much money or how much debt do you owe? By paying off your debt, it makes your Vantage score go up. Paying off debt does not necessarily make your FICO score go up because that is not a factor in the FICO score. So just kind of prepare your mindset for what this looks like. So because they have different criterias, things affect them differently. So FICO score is what you want to look for. Now, amongst iPhone and Android, there are so many different versions of the phone. That's why when somebody asks, oh yeah, what phone you got? If you just say Android, that's not enough for them. They want to know which one. Is it a Galaxy? Which Galaxy is it? Is it the Galaxy 10, the Galaxy Tab? They want to know. If you say iPhone, okay, which iPhone? You got the 7, the 10, the 12. Just like there are different versions of iPhone and Android, there are different versions of the FICO and Vantage score. So if you look at this report is a FICO score 08. That's what this score is here. Now, remember I said before, they have two different scores. The second score is down here. This is a FICO auto score 8. Auto score meaning collateral. So if a bank or a credit union pulls credit reports like this, that auto score is what they would use for something that has collateral. If they got an unsecured loan, like just cash, they would use the regular FICO score. So as we see, these are two totally different scores. One is a 614, one is a 613. So we're going to break down these scores here. If you all see, these scores have these little codes next to them. Those codes are the makeup of the credit score. If you want to improve your score, first thing you want to look at are these codes. So these codes list reasons or definitions as to what this code means. These codes are also in order from the one at the top being the one that's impacting you the most, and the one at the bottom being the one that's impacting you the least. So this gives you an order of operation. What should I focus on first to maximize the results of me building my credit score? So with that being said, just go through a few of these. We have, just go through a few of these. We have serious delinquency. That's just saying that this credit report has some delinquency in its past. So that can be delinquent accounts, that can be late payments, that can be collections, tons of things they can be referring to when they say serious delinquency. Next is proportional balance to credit limits is too high on bank revolving or other revolving accounts. Super long, super wordy. You look at it like, oh my goodness, that is so much. What does that even mean? That is a fancy way of saying that this person has a bank credit card. There are two types of credit cards you can have, a bank card and a store card. A bank credit card is issued from some type of bank. So like Capital One, Credit One, Bank of America, all those are bank credit cards. You can use them anywhere. Store cards you can only use at a specific place. If you get a Macy's credit card, that's a store card, you can only use it at Macy's. So this is pertaining, it says bank or national. So we know it's a bank card. So this is referring to a regular credit card, so not a store card. And what it means is this person is using too much of their credit limit on their credit card. Plain and simple, that's what it means. So As we see, this is the second one on the list. When we said highest is most impact, lowest is least impact. So this is second on the list, which means this is pretty high impact. This is something we should be focusing on. So what this person can do to increase their score, serious delinquency is not a whole lot they can do for that, except unless their delinquency is wrongfully placed on their credit report. But if it's rightfully there, all they can do is change their behavior going forward. It's in the past, Hakuna Matata. All we can do is look forward and keep on going. But for the second one, the credit limits, the best thing they can do is pay down the credit card debt. Keeping your credit card debt 20% or less will increase your credit score. So, like I said, we got a class talking about all that, going into details about that little tidbit. Y'all see, I'm plugging our classes. Y'all gonna be in all our classes after this. Watch. So next is length of time accounts have been established. This one is a very important code because it has a key word in it that I want you all to realize something about the credit report. This word right here, time. When you see time in one of these exclamations, time equals your immediate 12 months. So what that means is this 14 says length of time accounts have been established. So new accounts hurt our credit because length of history makes up 15% of our credit. It's not a whole lot, but how long you have had your credit can impact how good or bad your credit looks. So, but when you see this word time, it means your immediate 12 months. So when it says length of time accounts have been established, this means you have new accounts that are opened in your immediate 12 months or less. When we talk in credit, your immediate 12 months is the most crucial time period for anything. If you get a new account, it hurts the most in your immediate 12 months. If you get a late payment, it hurts the most in your immediate 12 months. May 2021 to May 2020. Anything that happened within that time frame is your immediate 12 months. So keep that in mind when you see the word time. Another thing, when you see the word time, scratch it off your list. The only thing that can fix time is time. That's it. There's nothing you can do to fix the situation is due to time, except continue positive history and wait it out. As time goes on, because what's going to happen is these accounts are going to get older. As they get older, that's going to make the credit score go up. It's going to start to look good now. There's nothing you can do to make it get older. You just got to let time do its job. So when you see time, two things. Immediate 12 months, realize there's nothing you can do about it, but keep your positive activity going. So don't dwell on anything with time, just positive history. All right, next is too few accounts currently paid as agreed. So this tells us this person has some account on his credit or her credit report. Oh wait, nope, this person's name is Joe. Well, we don't know. Their credit report. They have some account on their credit report where they have not paid as agreed per their agreement with that institution. So this can mean they have some late payments, they have some charged off accounts, but this tells us there's some history out there that is not being paid as agreed. As we see, that's the lowest one on the list. So it may not be as important as the other ones, but once we get down the line, that might be something we do want to focus on later. I believe one of these are different. So if we look at, oh, here we got 13. So 13 on the auto score is the only one that's different. And it says time since delinquency is too recent or unknown. Remember what we said about the word time. Time is your immediate 12 months. So this means this person has delinquency that happened in their immediate 12 months. So now I haven't even looked at the credit report yet, but from this information alone, I can see there's some late payments out there. They're using a high portion of their credit cards. They may have some charged off or some collections out there. So it's kind of telling a story about this person. But remember, time, all you can do is keep your positive history going. As negative history gets older, it will matter less and eventually fall off. All right, next is the credit summary. If I can get, there we go. Next is the credit summary. So this just kind of highlights what's coming on in the next pages here. So this credit summary, this was made for lenders to be able to get a snapshot of someone's credit without having to look at the full report. So they can see what type of accounts you have, how many different accounts, so how many late payments you have. So for instance, on this credit report, some of the terminology may be different, but on this credit report, this HST neg means historic negativity. That's saying late payments. How many late payments does this person have? So historic negativity, theirs is 2 to 5. So they have 2 to 5 late payments on this credit report. So, where's my clear? There we go. So it just gives a little bit of detail about different accounts, what type of accounts. So I'm not going to go through all this. Like I said, not all of it is super relevant to us as consumers, but they show your trades, your revolving, installment. Trades will make up revolving and installment. So if you add these two together, they should equal your trades, as we see it does. Then you have inquiries. That's another big one that we should pay attention to. So inquiries are when we initiate for someone to pull our credit report. Next, they give us a little bit of detail on each account. So they show our revolving and installment accounts. I'm gonna break this down a little bit just so we can kind of understand some things later. Once again, this is a credit nerd tangent, so this may not apply to us as consumers, but it's gonna help you understand some things a little later. So this word right here, high credit, means two different things for revolving and installment loans. If you have a revolving loan, which would be like a credit card, a charge account, anything that has a limit. If it has a limit, it's a revolving account. If it does not have a limit and it has a fixed payment date, that's an installment loan. So think about like a car loan, a mortgage, student loans. Those are all installment loans. They give you a fixed payment amount for a fixed amount of time. Eventually, you will be done with this. Revolving accounts is not a fixed payment. It's a monthly payment that can change. They give you a minimum payment. The more you use on this revolving account, the higher your minimum payment. Revolving accounts, think of them like a revolving door. You can use it, come out, use it again. So you can use this card, go buy a new Xbox, new PlayStation, pay it off to zero, then go buy another new Xbox, new PlayStation. You can do this cycle for as long as you want. Only you or the lender can end it. So high credit, when we're talking revolving loans, this is saying how high have or how much of this revolving debt have you used? So as we see, this person's high credit is $499 and their credit limit is $500, which means the highest they've taken this card was $500. What this helps me and helps lenders see, if you see a high credit that's higher than the credit limit, that means A, either they have a charged off card that gained a lot of interest, or B, they had a card that they had a higher limit on, and then the credit card company lowered that limit. So it gives you some room to probe and ask a few questions. Okay, well, your high credit is substantially higher than your credit limit. You can't use more than the limit. So let's explain why that happened or what happened. Maybe it was higher at one point. Your limit was higher at one point. Maybe you just had an account that went bad during a bad period in your life and you couldn't pay it back. Whatever the case may be, it gives room to probe and figure out some things. High credit for installment loans. This is where it shows if we added up all the installment loans on your credit report. So for this person, that's two, they have 2 installment loans. If we add up both of those amounts of the installment loans when they first started, that amount would total 28.3K. So that means the most installment debt they've had was 28.3K. What we are supposed to see in installment loans is the balance should always be lower than the high credit, as you see here. See, their balance is 18. Oh man, I keep moving. I'm sorry. Their balance is 18.8. So that's 10,000 less. So we see they have been paying down their installment debt. What you typically see with people who have student loans and who are still in school, their high credit is lower than the balance. Because remember, high credit is where your installment loans began. If you got your student loans and they totaled up to $50,000 and that's the only thing you had on your credit report, your high credit will be 50K. Now, if we're still in school, our loans are being deferred. While our loans are still being deferred, they still accrued interest. That's how the balance gets higher than the high credit. So that's what high credit means for both installment and revolving. Next, it shows here, another thing I want to point to is the monthly payments. They show how much you pay per account for your monthly payments, and then they total them up at the bottom. So you can see how much someone is putting out a month as far as towards debt. So this, from a lender standpoint, this helps them figure out, okay, how much can we approve them for based off what they already spend in a month. So one thing with student loans, a lot of cases with homes, unless they've changed this rule recently, but a lot of places have to go off of 1% of what your total balance is for a monthly payment. Even if you're on income payments or is deferred, they have to go off 1% as your payment. Keep that in mind because that drastically affects how much you can afford in a home. Last part, which is very important, is the available credit. Remember, this is only pertaining to, hold on, let me speak. I'm sorry, guys. I keep bumping my computer. So available credit is pertaining to how much of someone's credit limit are they using. So as we see, we said earlier, this person is using a lot of their credit limit. So it shows they only have 14% available. If y'all remember earlier, I said you want to use 20% or less. They're using more than 85%. So we already said one thing I know for a fact they got to do is pay down this credit card for this score to go up. So 20% or less. All right, that's the credit summary. All right, next is collections. I see collections a lot on credit reports. Actually, it's probably the bulk of what I deal with. One thing about collections is, well, first I'll explain how they work. Let me switch here. Give me 2 seconds. All right, so this is how collections work. So let's say we have a credit card. We owe ABC Credit Card Company. We owe them let's say we owe them $300. ABC credit card is calling us trying to get this 300. They're not making it happen. They're like, look, man, we wasting more money trying to get this 300 than we would have if we just actually had it. So let's just get rid of it. Let's just get it off our books. We gonna sell it to ABC Collection. So they call up ABC Collection. They say, hey, we want to give you this $300 debt. Here's the background on this debt. ABC Collection says, hey, I tell you what, if you give me this $300 debt, I will pay you $80. They say, you know what? Fine. We don't care. $80 is better than what we would have gotten. You give us $80, then you take this $300 debt. So now we owe ABC Collection Agency $300. ABC Collection Agency is calling us, harassing us, calling our moms, our aunties, our co-workers, the waitress we had at the restaurant on Sunday, everything. They trying to get in touch with us. So they call us, they finally get a hold of us. They say, hey, look, we understand you're going through a lot. We understand you're trying to make some things happen for yourself. You want to improve your credit score. Don't worry about giving us $300. You can just give us $150 and that'll be fine with us. We can settle at $150. See, the reason collection agencies are so willing to settle is because they paid pennies on a dollar for the debt anyway. I didn't pay $300 for the debt. What do I care if you paid $300? Pay me enough to make a profit and we can call it even. So this is called settling a collection. Now, keep in mind with collections, when you settle, it can still stay on your credit report. It will just show settled for less than full balance and zero. It'll show your balance is zero. as long as the collections is on your credit report, it does still hurt. It hurts less when it's paid or when it shows it's settled, but it still hurts because it's there. Our goal is to get the collections gone. So what I tell people, depending on what their goals are, if you have a collection that's low enough, pay it in full and negotiate for them to remove it before you pay them the money. So $100 debt, 200, depending on what the person is trying to do, maybe even a $300 debt, I would say just pay it in full and negotiate for them to take it off your credit report altogether. If you do that and they agree with your terms, conditions, next thing you want to do is get that in writing. Thank you so much. So for agreeing that if I pay you $300, you remove this collection from my credit report completely. Can I please get that in writing on your company's letterhead with your signature, your manager's signature, whoever. This is your ammunition for if they don't hold up their end of the deal. Because if you pay them the $300, they send you the receipt, or you have your bank statement or your bank printout showing that you paid them $300. Let's say they don't take it off your credit report. You can send that letter with the proof of your payment to the credit bureaus and they'll remove it from your credit report. So keep that in mind. A good rule of thumb is 30% through 50% when we're talking settling. I only advise settling a collection when it's like super high. Like if you own like 800, 900, 1,000, like that's a lot of money. You can settle that. You can settle that and just let it sit. Some of them do fall off before they've reached their 7 years. Some of them don't. They hang around the entire time. Either way it go, I refuse to pay that much money for something knowing they didn't pay nowhere near that. You're not about to get that much profit off of me. That's just me. I can't bring myself to pay that much money for something that somebody else did not pay that much for. So 30 to 50% is your range of settling. So you want to figure out what 30% is, figure out what 50% is. If we're going off this 300, 30% would be $90 bucks. 50% would be $150. So you know when you call them, you start at 90, you work your way up to 150. The way you negotiate, of course, is a little more professional than this. But if any of you have ever negotiated anything at like one of the little stands in the mall or at a flea market, you go, well, let's say you're walking through the mall, one of the guys who owns the stands like, hey, I got this camera. You want to look? You should buy this camera. Look, like, okay, you're looking like, oh man, that's a nice camera, but I can't afford, $300 for it, man. Let's do 90. And they're like, oh no, I can't do 90. It's too low. This is a brand new camera. Can you do 100? And so you negotiate. The difference is with the collection agency, you start low and allow them to work it high. You know that your maximum is 150. You start at 90 and you allow them to get to 150. You want to find that sweet spot between 90 and 150. If you don't catch it and they not budging, be very friendly. Thank you so much for trying to help me. You can get more bees with honey than you can with vinegar. Be real friendly. Get off the phone, hang up, call them again tomorrow. Call them again next week. Collection agencies is a commission-based game. They get paid based off the money they collect. In a lot of cases, sometimes they get commissions and bonuses as well. So the day you call, that person may not need their money. They may not want their bonus, may not want their commission. But eventually you're going to come across somebody who needs it or who wants it. Or what I always tell clients is one or two things going to happen. Because consistency is key. Either they're going to be desperate and go with the deal, or they're going to get extremely tired of you calling. Everybody in that center is going to know your name, and they're going to settle with you just to get you off of their phone lines. One of the two is going to happen. Lastly, another thing I see with collections is ABC collection agency is trying to collect this $300. They're not getting it, so they end up selling to DEF collection. Now DEF is calling us about $300. This happens all the time, but this is illegal. You cannot sell a debt if you're not the original owner of the debt. That is called re-aging the debt. This happens all the time though, because two reasons. People don't answer the phones for numbers they don't know, and people don't open their mail. If you want to beat this, open your mail. That is the biggest proof you could ever have. If you have a letter from ABC Collection Agency collecting on a $500 debt from BJC Hospital, and you have a letter from DEF Collection Agency collected on the same $500 debt from BJC Hospital, you have two letters of two different companies trying to collect on the same debt. Proof is in the pudding. You can send both of those letters to the credit bureaus, and they will remove that from your credit report. All right, so that's collection agencies. Now we're going to go back here. Give you all a little backstory on collection agencies. Boom. So that's collection agencies. Negative information stays on the credit report 7 years from the original date of delinquency. The date of delinquency, I'm sorry. That is including collection agencies. Oh no, I thought I had a picture of collection agencies on her. I am so sorry, y'all. I want to show y'all that. Oh well, I'm glad we went through that example. Next is trade lines. Trade lines, I know it's going to sound really, really vague, but trade lines is anything that is not a collections nor a public records. So we'll talk about what public record is as well. But trade lines, this is where you see the meat and potatoes of credit. Shows you all the different accounts that person has, their payment history with those accounts. It shows how long they've had them. It shows how many times they've been late. How late were those payments? You can literally see someone's life story from their trades. So here's an image of trades. This is Joe Steenberg's. This is his trades on his credit report. All the stuff we saw in that credit summary and in the credit score, the different codes, we see here in the trades. So we see they do have some late payments. They have 5 late payments. It said they had 2 to 5 late payments. I'll show you where we see that at. So over here, see these little number matrix? This is the payment history. It shows how someone has paid based off on time, which is a 1 is an on-time payment. Whenever you see a 1 means on time. Next is 30 days late, which is a 2, 60 days late, which is a 3, 90 days late, which is a 4, and some of them even have 120 days late, and that is 5. If you see an X, or sometimes some reports, I believe it's a 0, that is deferred. So with this person, we see he has 1 payment that is 30 days late here. 2 payments is 30 days late here. 2 payments is 60 days late here. So they got some late payments. Remember, one of those things said accounts not paid as agreed. It looks like this account was closed by the credit grantor because they did not pay on time. What it looks like is they end up realizing what happened and started to pay it on time every month, but the credit grantor still closed the account. So then next it shows our account balances. This is where we can see what type of loan do people have. So we see this person has 2 cars. We know these are car loans because it says automobile right there. So we know they got 2 car loans. The high credit for this car loan is 13.6. The high credit for this one is 14.6. That's where these car loans started. They've had this car loan. So I have the year this credit report was pulled. I want to say, 2017. There we go. So this credit report was pulled in 2017. This car loan was opened in 2013. So because of that, we see they had it for a few years. They've paid off a nice chunk of their car within the few years they've had it. Now they've had this car since 2015 and it's 2017. So they had it for 2 years. Look at the balance. They haven't paid off a whole lot of that car in 2 years. What that tells me from a lending standpoint is they have a really high interest rate on that car. So when you have a high interest rate, you pay more in interest than accounts with lower interest rates. So more of your money is going towards the lender versus towards the actual debt that you owe. So next we can see where these accounts are at. I'm jumping back and forth here. based off relevance. But we have Vantage Credit Union and we have regional acceptance. Then on this next column here, it shows payment history. So in your payment history, we see, I'm sorry, not payment history, it shows your terms, your payment terms. So we see that this car loan is 66 months, 5.5 years. This M254 means they pay $254 a month for that car loan. 66M, 66 months at $371 a month. Down here, they have two credit cards. These are revolving accounts. So they have a charge account. So this charge account would be a store card that tells us this was a store card for brand SRC, whatever that could be. Then they also have a bank credit card with Capital One. If we look, remember this account is closed, so it does not have a payment amount. But if we notice, this one does not have a term. Remember, revolving accounts do not have a term. It only has a minimum of $25 a month. So we can see someone's history on this part of the credit report. This tells that person's story. This opens the door for us to ask questions and say, man, this person got a lot of late payments in this little window of time here. Hey, what happened during this time period that you got so many late payments? See, this is the human aspect of credit, because at the end of the day, lenders have to make a decision based off numbers and humanity. See, credit reports just show numbers. We have to probe and ask questions to understand the humanity. Late payments on the credit report say I'm horrible with payment history. If you give me a loan, I won't pay you on time. I may run off on you with a car. You might have to repo it. What it does not say is, my mom got sick and I had to take off work to take care of her. I lost my job because of a pandemic. I couldn't pay things on time. So credit reports don't show humanity. Keep that in mind, because everything we going over with this stuff, this is not a reflection of who you are as a person. Do not allow your credit report to define you. This is numbers that are used to help lenders make the best decision for themselves and their customers or members. All right, so next is inquiries. A couple different types of inquiries. First one we have is regular inquiries. A regular inquiry is when we so it's two different types. You have a hard or soft pull. These are when we either go somewhere and say, hey, I want to apply for a credit card. I want to apply for a car. Or sometimes they happen accidental when we at Macy's get a couple pair of jeans and they say, hey, did you want to take 20% off your purchase by applying for our Macy's card? A lot of us be like, well, shoot, I know I'm gonna get denied, but yeah, let's go on and do it. Those are typically hard inquiries. A hard inquiries negatively impacts your score. Soft inquiries do not. The reason being is because one bad apple can spoil a bunch. So if you have tons of people who are doing credit card fraud and doing different things like running around different stores, obtaining cards, running them up, and then running off on the company, they made it so inquiries hurt. So you may be able to get that off once, maybe twice, but after they see all these inquiries and your credit score takes a hard enough hit, you'll stop getting approved for things. So one bad apple spoils a bunch. So now when you apply for things, it does hurt your credit 10%. This rule, there's a cheat code to this rule when you're applying for cars and homes. When you're applying for a car, you have 14 days from your first credit pull to get as many as you like, and it only impacts your credit once. All the inquiries will still show up on your credit report, but it only impacts the actual score once. They do this so you can shop around, get the best interest rate for cars. Same thing with homes, except with homes it's 30 days instead of 14 days. So keep that in mind. Next is promotional inquiries. I rarely ever see these on credit reports. I do see them on the ones from annualcreditreport.com. So the promotional inquiries, these are like when companies reach out to us and send like stuff in the mail saying, hey, you've been pre-approved, no money down for a car. They got our information from a promotional inquiry. So they get very little information and they have to make judgment calls, determine, okay, these are people that we can market to because they will most, based off the little information we can see, they might be approved for what we're offering. So car lots, credit cards, all the stuff, they do these promotional inquiries to figure out, okay, who should we market to figure out who can get approved for what we're offering. So when you start getting stuff in the mail, those typically come from promotional inquiries. Here are inquiries. This is what it looks like on that credit report. So we see this person does have 10 inquiries. They show the dates that these inquiries were pulled and what places pulled them. So what lenders look for, they try to see, okay, what did these inquiries come from? As we see, we have August 19 to August 28. Have a lot of inquiries during that time period. This tells the lender, hey, this person was applying for a car. We see all these different, so we got Capital One, CFNA, CUNA lending. So that's typically when credit unions partner with different car lots, they'll allow them to pull credit reports for their institution at the car lot. And so, yeah, so they have different banks and credit unions. So this tells us, hey, they were applying for a car. So we know that all those inquiries are due to an auto pool. The other ones are just random credit pools. So that's what the inquiries look like. Keep in mind, inquiries stay on your credit report for 2 years. So if you got it pulled August 28, 2015, they'll fall off August 28, 2017. All right, additional information. This part on the credit report, this is where, now I rarely ever see things on this part, but this is where you can add statements or special messages on your credit report. So let's say you disputed something and this dispute did not come out in your favor. The credit bureaus did not agree with you. The company was able to verify, whatever the case may be. You can submit a statement that they have to put on your credit report. And lenders will see this when they pull your report. So let's say you were 19, you co-signed for a car. You probably shouldn't have did it at such a young age, and you end up getting left with that car because that person stopped paying on it, and now it damaged your credit report. You tried to dispute it. The car company was able to prove your signature, was able to prove that you did co-sign for this, and it did not come off your credit report. You can submit a statement explaining what happened in that situation. Now, given this may or may not sway the decision of a lender, but if you want to use everything in your arsenal, this is something to put in your arsenal. Next is end of the report. So end of the report just shows the contact information for their credit bureau who you pulled the report from. And it'll show where their number, their address, how you can dispute items that's on there, and it gives you a means to contact them. This is what that looks like. So as we see, this was a TransUnion report. They have TransUnion address, TransUnion phone number, what type of scores these were. And then at the very bottom, they have end of credit report. Lastly, just some things to take with you. Nobody is too big or too bad. Keep that in mind. So you can bring a civil suit against anybody, even the credit bureaus. A lot of people see agencies like credit bureaus as untouchable. Like, well, they're the ones who make the decision. How can I fight them? You can take anybody to court you want. So keep that in mind. And also, you can use the CFPB, Consumer Financial Protection Bureau. CFPB is like the watchdogs of finances. If you have someone who is pretty high in rank, like a credit bureau, do you wrong or do you dirty, how do you solve this issue? Like, they're the ones you run to when other people do you wrong. How do I tell that they're doing me wrong? Consumer Financial Protection Bureau. See, this is a government agency that helps consumers with companies that are not doing what they're supposed to do, or companies who may be doing consumers wrong. So you can use this for credit bureaus. You can use this for student loans. You can use this for other financial agencies, financial institutions. I've done this for clients, for lawyers who did inaccurate bankruptcies on some of my clients. You can use it for literally almost anything with finances. Use them. They're there. They're free. It's a government agency. These are one of the things that government puts in place to help people with their finances. Thank you so much. Lastly, just remember to stay connected. Check out Prosperity Connection on our website. Check out our Facebook, our Twitter. Check out what we're putting out on there. Like I said, we post a lot of classes there. Any of our events we may be having. Like I said, we may not have a whole ton of events happening right now, but hopefully in the near future we can get back to doing so. And any changes and articles and things we have within our organization, you can find on one of those 3 platforms. Lastly, any questions? Make sure there's nothing in the chat. Okay, we good. All right. Well, thank you so much, everyone, for coming out. I hope you all enjoyed. I hope this information was useful. Now that you have this knowledge, I hope you all took some notes and took some screenshots. Go pull your credit report. Make some sense of it. If you can't make sense of it, call me. Contact Prosperity Connection. We will help you read through this thing. Thank you all. You all have a good rest of your day.